Rashid, I'll kick off and I'll hand over to you.
Yeah.
So good
We are
afternoon,
ready.
folks. Good afternoon and welcome to the Little Champs webinar on the road ahead for Little Champs. We are acutely aware that over the last 1.5 years, this product has underperformed. And what we'll discuss over the course of the next hour or so is the changes that we have made in the last 8, 9 months to the portfolio. Why have we made those changes? What are the exits from the portfolio? What are the recent purchases? So take you through that, to take you through Little Champs' journey. It's now been nearly 5 years, 5 years for Little Champs' Little Champs' existence. To take you through that 5 year journey and to explain the more recent changes, I'll request Ashwin Shetty, the fund manager, to take over.
Thanks, Saurabh. Good evening, ladies and gentlemen. Hope all of you are doing well. So let me share a small presentation. Yeah. So as Saurabh said, we are completed more than 4.5 years into the Little Champs. So I think good starting point is to look at the journey. So we launched Little Champs in August 2019, and the first 9 months were not great. Actually, there was a COVID first wave. We hit the returns of the portfolio as well as the earnings of the portfolio companies. But then we had a very blazing run starting from the second quarter of FY21 all the way up to September 2022. So as at September 30, 2022, the portfolio had delivered close to 31% returns CAGR. But thereafter, the underperformance started. So the last 1.5 years, as Saurabh said, has not been great from a returns perspective. And we will go into the details of what has impacted the returns. But you will find that the returns, the blue line, is very highly correlated to the gray bars, which is nothing but the weighted average earnings growth of the portfolio companies. So you see the uptake from the second part here. It is matched by the uptake in the earnings growth. So between July 2022 to September 2022, the portfolio would have delivered close to 40% CAGR. The earnings would have constituted, the earnings growth would have constituted mammoth part of that return. So close to 80, 85, 90% of that returns would have been constituted by the earnings that you see on the chart. So you'll see that the downfall in the returns in the last 1.5 years is also coincided with the deceleration in the earnings. In fact, the last 9 months YTD earnings growth for the LCP portfolio has been negative. So the objective of this chart is to depict that there is a strong correlation between the returns of the LCP portfolio as well as the earnings growth of the portfolio companies.
So, Ashwin,
And
if you
another
don't
way
mind,
to corroborate is
just
also
one second, Ashwin, just go back to that
sure.
slide. So, folks, just to sort of clarify
Yeah.
this, if you see the gray bars is EPS growth. The portfolio CAGR was actually exactly in line with EPS growth till September 22. So the EPS growth was roughly in the vicinity of 30%, and the portfolio was also compounding at that rate till September 22. As Ashwin is showing you, since then earnings growth has disappeared, and in fact, as he's saying, last 9 months earnings have degrown for the portfolio. We'll discuss the reasons why. And as earnings have degrown, the portfolio's performance has stagnated. PE multiples for the portfolio, you'll see in subsequent slides. PE multiples for the portfolios are what they were 2 years ago. So a lot of people jump up and down about PE multiples. There is no PE multiple growth story here. PE multiples today for this portfolio are what they were 2 years ago. The main challenge for this portfolio has been earnings have come off, as shown in the gray bars, minus 13, minus 10, minus 7. And what Ashwin will now take you through is why did the earnings come off and what are we doing to remedy the situation? Back to you, Ashwin.
Yeah. And before going that, I think another way to corroborate what we said in the first slide is also to look at the shares which have been the top performers as well as the detractors. Again, when you look at the list on the left-hand side, you will find that this is the stocks which have been the top detractors in the portfolio. You'll find that, again, the earnings of these companies have been weak, top detractors, and that has been the key reason why this share price of these companies have been under pressure. On the other hand, when you look at the list of the companies which have contributed nicely to the returns in the portfolio, again, you will find that at the overall level, the earnings growth of these companies have been very healthy, and that has in fact translated into healthy share price returns for this set of companies as well. And what Saurabh said regarding the P re-rating, obviously when we started, this is a discovery portfolio as we have been communicating to you all. So there is a good up move in the P re-rating in the first 3-4 years of the portfolio. But again, when we look at the peak P at this portfolio, 32.5, by no means is this actually exorbitant number. Actually, for a portfolio where the return on capital employed is north of 20%, which have been growing their earnings north of 20%, 32.5 actually is a very reasonable number. And when you look at the PE as it stands today, it is 30.5, which over a 2-year period, it's a derating of 3% per annum. Again, when you look at the portfolio return, which has gone down by say 15% on an absolute basis in the last 2 years, this 3% correction in the price to earnings multiple is not a big factor. Hence, again, earnings has been a major factor which has led to the underperformance of the portfolio in the last 1.5 years. And another way to look at the performance of the portfolio the last 4.5 years is also look at in various phases. So again, here the portfolio did well. We were matching neck to neck with the BSE small cap. So the regulatory benchmark for this portfolio is BSE 500. This is because of the limited options that we have choose. But we have shown here BSE small cap comparison with BSE small cap. We find that the first phase we were in neck to neck with BSE small cap, and this is again after this is net of fees. This is net of the price impacts that we have in the small caps and other charges, brokerage, etc. So despite all these charges, the net returns were neck to neck with that of BSE small cap. It is in this space actually where we struggled, where both on an absolute basis as well as on a relative basis. But what we are seeing since the last 2 months, even though the absolute return is negative, but the level of underperformance seems to be correcting. And if I look at only the March, this is from 7th February, but if I look at the March, this may the gap between the LCB performance and the BSE small cap will be even more significant. So we seem to be going into a new phase in the journey.
So just to sort
And
of concentrate
given
minds,
all this,
just to concentrate minds, this
sure, sir.
coming back to the right hand side, if you just take the cursor to the right hand side, red dashed line, right? Because just the red dashed line in the right hand side chart is the P the P premium the P multiple of LCP, the 1 year forward P. We are where we were 2 years ago. The P on this portfolio is no different from what it was 2 years ago. The last 2 years underperformance has been on account of weak earnings growth. In fact, earnings degrowth over the last 9 quarters. Our job is to fix that. That's what our clients pay us for. Our clients pay us to invest in companies whose earnings are going up, not down. Last 3 quarters, we have failed in that. And what we'll try to describe to you is how we have tried to turn that around. Some of the improvement in performance in the recent weeks, the recent quarters is on account of us reinvigorating the portfolio, getting back to discovery. Sarshan, over to you to explain the
Yeah.
reinvigoration of LCP.
Yeah. So how we are actually getting back the focus on earnings growth is one is like taking a very hard look at the earnings growth prospects or rather revival in some of our long-standing holdings, and we will take you to some of the names. And second is also to get a fresh set of stocks where we are very confident that over the course of next 2 to 3 years, they will deliver us strong earnings growth. In fact, I would say that the first 3-4 years, the great journey of LCP is also because we got a lot of fresh names. Those names actually delivered very strong earnings growth. And there's also a bit of a discovery element which added to the return. So we are trying to actually bring back those days in the Little Champs. In fact, just to emphasize, was the whole premise, this chart which is shown here. This was the whole premise on which Little Champs was launched. To get the stocks which are hitherto undiscovered, but which are showing very strong earnings growth. And as they show earnings growth, there is also a discovery element. There is also P re-rating which happens during that journey. So the course of last 8 months, we have tried to also get back the focus on this part of the portfolio. And we will start with how we are trying to assess the earnings growth prospects of the long-standing names in the portfolio. So we have deliberately picked up the companies which where the earning drawdowns, and so the share price returns have been sharp. So one of the companies which has struggled, especially in the last 1 year or so, is Tarson's. So Tarson's actually has been a very, very consistent company till FY20. So the maximum drawdown in the earnings that the company saw, at least in the FY15 to 20 period, was only 9%. So fairly pristine company, very, very consistent earnings. It supplies consumables to the laboratory diagnostic labs, to the research institutes, and so on. What happened in the course of the next 3 to 4 years? There is a wild oscillation in the earnings that we saw. So the company benefited significantly in FY21 and 22 because of the COVID. So during COVID, we had a wave of PCR testing. So Tarson's, because it supplies these consumables which go into this testing, it saw a significant uplift into the both the top line and the earnings. But what we have seen in the last 2 years is this unwinding of the COVID demand which is happening. So obviously, there was a very big base, especially in FY23, which was there to compare with. But we also saw that there was an unwinding of this demand. So one thing what happened is that during COVID, obviously the user demand for all this COVID-related stuff increased. But also what happened is that there was a general expectation that COVID will last longer than what it actually did. So we had first wave of COVID, we had second wave of COVID, we had the third wave of COVID. So generally, expectation was that this COVID will continue for a longer time than is actually did. So there is a lot of inventory also which was built up into the system, whether it is in the consumables market, diagnostics, or generally. Plus, there is also many of us will remember that logistics was a big challenge during COVID. So there is also a excess supply which was built because of this high freight cost, because of the high container shortage of the containers. Now what we have seen is that now the COVID disappeared, but the supply was there, inventory was built. We have seen the winding down of that inventory which has happened. And on top of that, we saw the interest rate cycle, at least in the Western world, rising for the first time in a long period of time, which meant that the dealers, the distributor had to go lean on the inventory working capital. They simply couldn't had the wherewithal to finance, have a very high working capital and finance that with a very high interest rate. So all this actually the euphoria which was there in FY22 and 21-22 that actually turned upside down in FY23 and 24. So as a result, we have seen very sharp drawdown in earnings, which has historically not been the case with Tarson's, which has happened in the last 1.5 years. But as we had had, we believe that the prospects of the companies are good. One is that we are seeing, at least in the recent months, there is a lot of stability. So we track the export numbers for Tarson's very closely. So we are seeing that from very sharp negative growth in exports, the exports are now moving into positive territory. Similarly, our channel checks also suggest that the destocking cycle seems to be at the end of the day. Many of our portfolio companies, not only Tarson's, Alkyl also I will discuss. These essentially cater to they are not cyclical industries. These are necessities of the life. Like people will not stop testing, people will not stop buying pharmaceutical products. So there is a limit to which the destocking can happen, and our recent channel checks as well as the reported numbers of the company suggest that we are near the end of that destocking cycle. So that gives us confidence that FY25 we should see a revival in earnings for Tarson's. On top of that, the companies also introduced some very interesting products like PETG bottles, which so far has been only imported by the likes of Nanjing in India. They are also coming up with serological pipette tubes. Also, I think 2-3 years down the line, I think cell culture will also ramp up nicely for the companies. In all, we saw, of course, we saw that last 3-4 years there is a wild swing in the earnings. But as we head ahead, we think that the prospects of the company should be better, and we should go back to the old days of consistent and healthy earnings for Tarson's. And a similar story more or less repeats for Alkyl also. This is one company which benefited very massively during COVID. So one of its product called acetonitrile, it benefited on two fronts. One is that on the demand side, it found an application in COVID-related drugs like molnupiravir. And on the supply side, because China was virtually shut during COVID, there was no supply of acetonitrile. So on the demand side, there was a significant increase. On the supply side, there is a shortage. So which meant that not only the volumes of acetonitrile rocketed, but also the realization per kg. For what used to be like 200 to 30 rupees per kg went up all the way to 400 rupees per kg, and that was all flowing to the bottom line. Hence, we saw a very sharp uptick in the earnings in alkyl in FY21. But again, as the COVID unwinded, and high base of FY21, we saw that FY22, the earnings started decelerating. We saw some bit of stability in FY23, but what added to the problem in the last 9 months, 12 months was China coming back into the equation. So China obviously was shut off from the global supply chain, but it was not that China stopped producing these chemicals during COVID. So as a result, as China opened up, we found that whatever was accumulated inventory in China, that finding its way into the global supply chain. So on the one hand, the demand came down. On the other hand, the supply went up. So we saw a complete change in the demand-supply equilibrium, and that put a very strong pressure on acetonitrile prices, especially I think second quarter of FY24 was one of the worst time. So the 400 rupees during COVID should have ideally normalized to 200 rupees per kg, but we saw the prices coming as low as 110 rupees. But again, why we
Ashwin,
continue to pursue?
if you don't mind, I'll just step in there. So, a lot of people ask us, folks, they say that why didn't you sell when the COVID profits of these companies were growing at, at such a rate? So you can see, right, Tarson's FY21, 70%, FY22, 46%, Alkylamines, FY21, 62%. So a lot of our clients ask us, not only on these stocks, some of the other stocks Ashwin's going to show you in subsequent slides. The question that clients often ask us is, why didn't you sell at the top then, right? So part of it, Ashwin's already said, right? We didn't know when COVID would end, but let's assume that even that's irrelevant. That suppose Ashwin knew and I knew that FY22 COVID would be done, right? Our point of view was twofold. One is if you look at the historical track records of these firms, Tarson's FY15 to 20, 32% PAT compounding, Alkylamines FY15 to 20, 32% PAT compounding. We are invested in companies whose historical pre-COVID track record was of stellar profit growth, right? So our point of view was even when COVID ends, these companies will get back to profit growth, and we still believe that. We firmly believe that. Tarson's, Alkyl, many of the other companies Ashwin's going to discuss in the subsequent slides will get back to very healthy long-term profit compounding, right? We didn't anticipate that we will have 22, 23, and we certainly didn't anticipate the first 9 months of FY24, whereas Ashwin has explained, China has cut prices of chemicals by anywhere between 40 to 80%, right? That being said, the life of a small cap investor is thus. You invest in small caps because these companies are able to generate these sorts of blistering profit growth figures, 32, 62, 40, 50% profit growth. But by the same token, because these are small companies and they're subject to global forces, you also expect to take the punches and suffer from 20, 30% price drops. The sign of a stable investor is stay invested, take the punches, don't panic, keep assessing, keep talking to Tarson's distributors, Tarson's customers, keep talking to Alkylamines' customers, Alkylamines' rivals. Figure out, is Tarson's losing market share? Is Alkyl losing market share? If the franchise is strong, and we believe Tarson's and Alkyl are strong franchises, if the franchise is strong, the comparative advantages are intact, market share is holding up, stay the course, take the pain. We've taken the pain over the last 1.5 years. We think good news is around the corner on earnings growth. And as we have repeatedly said in this presentation, if the earnings growth comes through, these stocks will do just fine in the months ahead. Back to you, Ashwin.
Yeah. So alkylamines similar to Tarson's, we think that the prospect is good. One important data point is that we are seeing the acetonitrile prices, which were falling one way down over the course of last 9 months, especially since November. Those prices seems to be stabilizing, also moving up, even though it is a bit gradual. So I think that sign is very, very positive. And another positive data point is that even though you will find that the the revenues are down minus 15% in 9 months FY24, but the company is actually posting positive volume growth. It all boils down to realization, which is actually on been a downward spiral. So positive volume growth is also a positive, good data point. So tomorrow when the realization improves, the revenue growth should see a significant uptick. So alkylamines also, we think that the prospects should be much better as we go ahead than what has been the case over the course of last 2 to 3 years. Another company where actually the earnings has been fairly good for a long period of time is GMM Fowler. Again, similar to Tarson's and Alkyls, the earnings growth, historical earnings growth has been very encouraging. And for the last FY21, 22, 23, you'll find that in some years the earnings growth actually has more than doubled, or doubled actually. GMM again did very well between FY21 to 23. It acquired its parent Pfaudler, which was at that point in time making EBITDA margin of 5-6%. GMM was able to successfully turn around the EBITDA margin to double digit. So the earnings growth actually came through very nicely. It's in the last 9 months that we are seeing the earnings decline. Again, because GMM's fortunes are linked to that of chemical companies, and because of the issues we discussed in the previous slide, the companies have cut down on the capex for the time being. And as a result, the order inflows for GMM has seen a decline over the course of last 9 months. And we also seen the margin deterioration in the standalone business. What used to be a 20% margin during the heydays has come down to 30 to 40%. Again, because of the negative operating leverage and because of the weakness in the demand. Again, here we think that the thing should look better. One is that we have seen order flows improving. For example, the third quarter, even though YOY is still declined, but we saw the sequential improvement in the order flows for GM Folder. Second confidence which we have in GMM is they have been able to build new growth drivers. Like rewind 10 years back, the company used to generate most of its top line as well as profits from the glass line equipment business. So as we speak today, glass line equipment constitutes something like only 50 to 60% of its top line and profits. Through acquisitions, through organic growth, the company has been able to get a head start into some of the segments like mixing systems, which globally actually is much bigger than the glass line equipment. So company has made forays into new segments. They are finding traction in those new segments, and hence we think over the course of next 2 to 3 years, both a cyclical uptick in the core business plus this new segments firing means that GMM should again get back to the old days of 20% plus earnings growth. And fine organics again more or less the same story, but because of the different things. So fine benefited in FY22 and FY23 primarily because its competitors, which are based out of Europe, they didn't have access to key raw materials like sunflower. For example, Russia, Ukraine are one of the largest suppliers of sunflower oil and certain other oils, which are the core raw material for additives, food additives, polymer additives. Because of the geopolitical turmoil, these competitors didn't have access to raw material, whereas fine, being based out of India, was just fine. And it was able to have access to this raw material, and hence it could supply to its customer in the export markets where its local competitors couldn't supply. And hence we saw both the volumes as well as realization improve significantly in FY22-23. Again, what we are seeing in 9 months FY24 is that because the world has opened, now competitors also have access. So some of that excess demand which fine had, that unwinding. So again, just to emphasize that despite this minus 35, minus 36%, which are big numbers, but when you look still the numbers and compare it with the FY20 base, fine would have still grown earnings north of 20% CAGR between FY20 to even after seeing this decline. So it is only because of the high upswing that we saw in earnings in FY20 to 23. These numbers notionally actually look bad. Again, here we think the polymer, which is one of the important consumers of, at least in the export markets for fines products, we are again seeing normalization of demand over there. Even though we have to see still a big uptick, but we are seeing signs of green shoots over there. And fine, again, similar to other companies which I discussed, they have introduced new products, very interesting products. So that should also lead to the top line growth as we go ahead.
So can I just make another
And
point?
sure,
So again, if you look at, let's take the example of fine organics. A lot of people will say that we saw Marcellus saw 116% profit growth in 22, 138% in 23. Surely it can't get any better. Why didn't you guys sell after 138% profit growth? Right? What our thinking was and remains is that these 2 years of hefty profit growth gave the company considerable surpluses, right, running into several hundreds of crores. Given Fine's stellar track record of reinvesting surpluses really cleverly, we were optimistic that they will do so. In fact, we now have tangible proof that they are reinvesting the surpluses really, really well. And to the extent investing is about putting money into companies whose profits will grow nicely in the years to come. That growth can only come if you're reinvesting hefty surpluses into new plant and capacity, which will bring profits in future years. So when you see companies doing the 187% PAT jump that GMM showed in F23, or Fine's 138% PAT jump in F23, you don't just sort of sell the shares and run saying that PAT growth peak ho gaya, ab girega. You look to understand from management, what are you going to do with this windfall that you've received, these excessive profits that you received? How will you reinvest them? And then you sit down and do the math yourself, that if this guy reinvests this profit into new plant and capacity, how much more money can I make? And therefore, when you go through a period like the first 9 months of F24 for GMM, for Fine, yes, the shares are getting pounded. You stay the course because you can see that there is new plant capacity, there's new business, new profits coming up down the line, and we want to profit from that. For that, you need to sit through a period of pain. Back to you, Ashwin.
fine. And Vmart is one company where, again, historically they have done very, very well for a retail company. For example, having a drawdown of just about 26%, which is a very high operating leverage, high fixed cost business. It's very, very credible. However, COVID actually changed the course for Vmart. Obviously, FY21 was a washout year because stores were shut for a large part of the year. But we saw things bouncing back in FY22 once the lockdown started easing off. However, what has this couldn't sustain in the subsequent years, primarily because of three things. One is that there is a significant increase in the raw material prices. So, for example, cotton is one of the most important raw material for VMart. And because VMart caters to the value segment, where really you have to be really cheap, your pricing power is very less, it couldn't fully pass on this increase in the raw material prices, and that impacted the margin. Secondly, the company also did few acquisitions like LimeRoad, where the company also invested significantly in increasing the digital capability of that company, etc., which all were upfronted, and that hurt the bottom line. And thirdly, but a more structural reason is that we also saw competition increasing. So VMart has focus has always been on tier 3, tier 4 cities, small towns, rural areas. For the first time in the last 1.5, 2 years, we saw that big players have also started entering this territory. For example, we all know that Zudio undertook a very massive expansion over the course of last 3 to 4 years. That has taken everybody of us by surprise. But the point is that these big competitors like Zudio, like Reliance Retail, they have actually reached the backyard of VMart. So VMart, obviously, we took some time to understand, what is ailing the business, meet the management. But finally, we think that while other things could improve, cyclical things, raw material price, inflation, etc., but competition is something which is going to structurally impact the earnings of the company, and hence we exited from this company around 3 to 4 months back. So VMart is one stock of all the list where we think that the road to earnings recovery will take a long time. There are structural reasons which will prevent that, and hence we took a call to exit from VMart around 3 to 4 months back. And the last stock which has been a pain in LCP portfolio is Avas. Unfortunately, the earnings here has been top notch actually. Even as we speak, in 9 months FY24, the company has delivered 15% earnings growth. What has impacted Avas is the exit of Mr. Sushil Agarwal, founder of the company. And this is one stock I would say that which has the P has derated of all the lot. I think the earnings have continue to remain healthy, and we think that given the tailwinds in the affordable housing segment, given the pristine asset quality associated with Awas, we think that earnings should remain top notch. But also, what gives us confidence that a new management now is roughly about 1 year into the picture. So Awas is now led by a gentleman called Mr. Sachinder. He comes from a Kotak background of 15 years. This team is now in place for the last 1 year. They have stabilized, and hence we see that the earnings growth trajectory should continue for Awas. And as the earnings growth trajectory continues, I think market will also realize that there is nothing to worry over here. Hence, we should also see a recovery in the PEV rating for this company. So, in and all, we think that for our holdings, FY25, FY26 should be a good year from our earnings perspective. We are already seeing signs of earnings decline bottoming out. We are also seeing signs of green shoots in the export market. Exports which were in negative zones seems to be turning in a positive zone for most of the companies. And furthermore, we should also benefit from the base effect of FY24. So that also should help the earnings look better, much better in FY25-26 for the portfolio companies. Now, second part of the thing which we are doing is also, besides taking a hard look at the existing stocks, also bought in the new set of stocks in the portfolio. So many of you must have noticed that we have made significant number of additions in the last 6 to 8 months. So again, as I said, this was a hallmark of why LCP portfolio did very well in the first 3 years. So we, for example, many of the stocks in the first generation LCP, it went on to turn multi-baggers, and we had to trying to get back that thing again. Why this discovery element took a backseat in FY22-23 was precisely because of COVID, because it was again so difficult to decipher what is cyclical uptake, what is COVID-related uptake. We were confined to our homes, sitting. I think very difficult to do channel checks at that point in time during COVID lockdown. So this all kind of impaired our ability to discover new names. But as FY23, as we head into FY23, where we had clean set of financials devoid of this distortion available, we again reinvigorated our discovery engine. As a result, we have added many new names in the portfolio in the last 6 to 8 months. So what I'll do is that discuss briefly about the investment rationale for some of these new names. And for example, one stock which we bought was RHI Magnesita. So why we bought is that we think RHI supplies refractories. Refractories are nothing but the inner linings in the furnace where steel is made, where the iron ores are melted. Refractories are very, very critical because if the molten metal comes in contact with the furnace, actually it can damage the furnace. Not only it damages the furnace, but from an energy perspective also, refractories play a very important role in maintaining the energy level, bringing down the energy cost, etc. On the other hand, it accounts for only 2 to 3% of the overall cost. But if this product fails, the damage can be quite significant. For example, you have to shut down the furnace for even a day, you will lose millions of dollars of production. So refractories account for only 2 to 3% of the overall cost, but can have a significant impact on the operations, on the overall operations. And within the space, why we like RHI is because of the market leadership it has. So RHI commands 30 to 35% market share, especially in the blast oxygen, basic oxygen furnace and the ladle segments of the steel making process. And this leadership is underpinned by the R&D of the global parent. So RHI Global, which is based out of Austria, it's a global leader even at the global level. Spends enormous amount of money in R&D, almost $50 million per annum, 1.5% of its revenues, and it has been kind of a pioneer in the refractories space. Has almost 1,700 plus active patents. For example, one of the interesting products which has been developed by RHI globally is now where you can actually sense which part of the refractory is getting weaker. So instead of and then kind of apply the refractories only to that part. Instead of taking down the entire lining of refractories, only apply the refractories on that which is getting weaker. So it not only saves a lot of cost to the customer, but it also brings down the downtime of replacing the refractories significantly. So very, very innovative product. And RHI India obviously is a beneficiary of whatever research development is being done at the parent level. But we also like RHI India, unlike most of the MNCs, where you'll find that there are multiple, there is a listed company and then there are a lot of direct subsidiaries which are owned by the parent. In case of RHI India, it's a very, very clean structure. So there is no entity of RHI which is separate from the listed companies. 4 or 5 years back, that used to be the case, but the parent has merged all the Indian companies into the listed companies. So India is the gateway for RHI Global. RHI India is the gateway for RHI Global. Secondly, the company has also made very, very important acquisitions. For example, one of the area segment of steel making where RHI was weak was flow control, where basically after the steel is produced in the basic oxygen furnace, it has to be bought downstream through equipments, various equipments. So there also you need the refractory lining. So RHI was weaker in that area, so it bought a company called High-Tech Chemicals around 2 years back, and therein it got the ability to even cater to that important segment within steel making. And finally, around a year back, it made a very big acquisition of Dalmia Refractories, almost a 2,000 crore acquisition. And that has given RHI now an ability to even cater to cement refractories. So cement is a very another big consumer of refractories where RHI was not present. By virtue of this acquisition, now RHI has also got a presence in Dalmia, in cement refractories. The earnings of the companies has been under pressure in the last 3 quarters, but that largely boils down to the integration of Dalmia. And I think many of us know that whenever there is a large acquisition which is made, initial 1 year, there is a bit of time which is required to stabilize the operation, to get the alignment of the culture, etc. We think that that is the main reason. And again, as we head forward, I think as this integration, etc., issues get clear, RHI should see a very good growth. On the positive side, the demand side remains very, very robust. We are seeing very good demand for steel. And taking a look at the expansion plans of announced by companies like Tata Steel, SAIL, and JSW, we think that the next 2 to 3 years from a demand perspective should be very, very strong for refractory players like RHI Magno. Second company here is Rainbow Children. We have written a detailed newsletter recently on Rainbow Children. So Rainbow Children is kind of a specializes in pediatric and gynec hospital. Large part of its operation is based out of South India and more particularly in Hyderabad. So why we like Rainbow is 2, 3 things. One is that I think it has got a very good quality talent of doctors, and that boils down to one is that the promoter himself is a very renowned doctor, Dr. Ramesh Kancharla, based out of Hyderabad, very, very renowned doctor. And secondly, they have created a very good culture around the doctor availability. For example, you will find that many of the hospitals, the night shift, there are no senior doctors available. It will be largely resident MBBS who will be there, or junior doctors at best. However, Rainbow, actually, you'll find that even senior doctors are present in night. And this is especially important in treating children, because you need to have 24 hours presence. The threshold for children is very, very low. So a night availability of senior doctor gives a lot of comfort to the parents. And this culture was driven by the promoters themselves. So they themselves actually stayed in night and build that culture. Now that it's highly imbibed into the culture of the entire Rainbow. And secondly is that because of its pediatric focus, you're also able to attract high quality pediatrics. For example, for a pediatric in a multi-talent, multi-specialty hospital, you not get a similar level of importance what he or she may get in a pediatric focus hospital. So we'll able to get, one is the volumes of cases, second is the complexity of cases. So your learning curve is also very, very high for a pediatrician to specialize in a pediatric hospital. And third is because the first two aspects, Rainbow is also able to cater to very, very complex pediatric cases. What we understand from our channel checks is for many of the complex pediatrics, Rainbow is the only way to go for many of the complex pediatric cases. Good doctors attract good patients, high number of patients and complex cases attract good quality of doctors. So Rainbow has been able to create a very strong this loop around doctor, high volumes and doctors. Another good aspect about Rainbow, which we like, is their hub and spoke model. What the company does is that it has a main hub where most of the complex surgeries are done, but it also creates a spoke around it. So what the spoke does is that it caters to simple cases, but it also, more importantly, acts as a catchment area for the hub. So many of the complex cases are referred to hub, etc. So good thing about this is that the spoke comes, the capex associated with spoke is significantly lower than compared to hub. So as a result, Rainbow is able to has been able to create very high gross block turnover because of this concept of hub and spoke, and also able to bring high volumes, high volumes. And thirdly, about the growth drivers, company has been able to successfully transition beyond the Hyderabad market over the last 4 to 5 years. For example, Hyderabad used to be almost 90% of its revenues 5 years back. Now it accounts for around 60% of its revenues. The company has been able to build this model in adjacent geographies like Bangalore, where the company is growing nicely. Then in around Chennai, Tamil Nadu. We think that there is a huge scope of penetration in this southern state, and over the course of the next 4 to 5 years, the company, if it is able to replicate the success in the Hyderabad into these southern cities, stroke areas, I think that itself can be a big growth driver for the company. And secondly, the companies also expanding into adjacencies like maternity services. Maternity services, while being a good growth driver by itself, but it also actually helps feed into the pediatric funnel for the company, because it's very high probability that child which is born in a particular hospital, it will be treated by the pediatrician associated with that hospital. So very good probability. So maternity services besides can also be a very good funnel for the pediatric growth for the company. The third stock which we added is PDS Limited. So PDS Limited is actually nothing but it's a link between the Western retailers likes of Asda, Tesco, with the small garment manufacturers in the East. What happens is like the companies like Tesco, Asda, while they will have their supply chain in shape for their core products, but there is a long tail of products which these companies have where they rely on the sourcing company like PDS. So PDS not gives very important services to these companies in the form of design. PDS has close to 200 plus designers on its roll. It also has access to the manufacturing in Bangladesh. It's almost 60% of the manufacturing that is given by PDS is based out of Bangladesh. So it takes away the headache regarding designing, regarding the compliance for the Western retailers. PDS takes care of it. So very good value proposition to these Western retailers. On the other hand, it provides for this fragmented garment manufacturer. They by themselves can't actually service because they are too small to go to an Asda, to a Tesco, to a Walmart. But because PDS is aggregating them at the overall level, so PDS is sizable enough to approach these Western retailers. Also, more importantly, it also provides working capital financing. For example, for a bank like HSBC, these garment manufacturers, small garment manufacturers based out of Bangladesh will be too small. But PDS, which is a relatively larger player, which has very big balance sheet in play, HSBC is more comfort in having PDS. So crucial financing is provided by PDS to the garment manufacturers. And on the other hand, it also has a very good, interesting front end model where instead of having very big sales team in place to do both the business development as well as servicing for the retailers, PDS has very interesting partnership model. So partners are nothing but these are the folks who have spent their career in big retailers who are now retired. So they come to PDS. PDS forms a subsidiary, gives them equity, and these partners now become the front end for PDS. So they, because they already have relationship with these big retailers, they are able to break into these big retailers. At the same time, there is a huge skinning game for these partners also, because they are getting equity in the form of 30 to 40% in the stake, besides the minimum fixed salary. So this is also very important construct which has been created by PDS, this partnership model. And we think that this is a very scalable business model. At the same time, the PDS also exerts control. It's not that PDS let loose these partners, but for example, the back end is all controlled, the finance is controlled, the capital allocation decision to some extent is controlled by PDS. So at the same time, PDS also maintains this back end control on this partnership model. And PDS is also expanding the horizon. For example, around 2 3 years back, it was largely providing the link of linking the retailers with this garment manufacturers. But now it is also getting into new areas, like for example, taking up the entire sourcing for these retailers for a country. For example, if Asta wants to source from Bangladesh, it will make PDS in charge of the entire sourcing operations in Bangladesh. In return, PDS will get the commission. So this is becoming more and more prominent for the retailers who don't want to take the headache of sourcing. They are offshoring their entire sourcing operations to guys like PDS. And third important pillar which PDS is building is the brand management services. So it's becoming in charge of entire merchandising solutions, wholesaling and distribution for big brands. For example, last 2 years, PDS has become this brand management provider for brands like Ted Baker and Forever 2021. So PDS is taking the entire global
Basically,
supply
just to sort of simplify it for people, what Jockey does sorry, what Page Industries does for Jockey in India, what Page Industries does for Jockey in India, PDS is doing something similar for Ted Baker in the UK. And it seems like they have more such brands in the pipeline where they basically take control of the brand. The brand is owned by somebody else, but PDS gets control of the brand. PDS gets to source the merchandise from Bangladesh and deliver it to the dealers on the high street in Europe and United Kingdom. Back to Yushman.
Yeah. Yeah. So again, PDS again, we think that because of this so much tailwinds which is there, should do well over the course of next 2 to 3 years. And one company which we added, which is quite well known, is Cera Sanitary Ware. The reason for adding this in the portfolio is one, we think that Cera has come a long way in the last 12 years. 12 years, 13 years back, it was coming way down the order in terms of the brand recall in the sanitary ware space. For example, the top of the mind recall used to be HIL, Hindware, it used to be Parryware, etc. But over the course of last 12, 13 years, Cera, because of its consistent product introduction, very innovative product launches, and expansion in the distribution, has now become a pan-India player. So it is one of the most frugal player as well as sanitary ware is concerned. So one is that enormous improvement in the competitive advantages in the brand recall that Cera has built. A second reason, again, we believe that given the strong registration that we have seen in the residential real estate over the course of last 2 to 3 years, this can translate into strong demand for Cera over the course of next 2 to 3 years, because sanitary ware is something which comes at the tail end of the residential construction process. Given again the strong registrations which we have seen in the course of last 2 to 3 years, this will be nearing completion over the course of next 1 to 3 years, and that should provide a very strong tailwind to Cera. And third reason which we added Cera is also because of the new growth drivers. For example, Cera is making a mark in faucets. Obviously, Jacquard is a very strong brand. It commands almost 50-60% market share. But Cera has also been able to grow nicely in faucets over the course of last 5 to 6 years, and it has opportunity to increase market share in faucets and also in the premium sanitary ware. So, it, for example, has launched a new brand in the premium sanitary space, trying to focus through branding and marketing on the premium sanitary ware space. So there is also an opportunity for Cera in that space. Uh, And moving to Taga Industries, it's somewhat similar to RHI, but caters to the global market. So Taga actually supplies mill liners to the mill. So mill is something where actually a lot of grinding happens, a lot of corrosion happens, etc. And you need to have a lining in place to protect the mill. Again, similar to refractories, the cost of this lining is not significant, but their importance is very, very high. For example, if there is a wear and tear in the lining, the entire mill has to be brought down. It has to be the lining has to be put again, and it means that significant amount of damages in terms of downtime. So Tega supplies this mill lining. It has operation. It has a part of its revenues coming from India, but also globally important markets like Chile, South Africa, and Australia. It caters to gold and copper mills. These are the two commodities where there is a lot of corrosion which happens. It's a highly corroded product, and Tega supplies linings mainly to these industries. Why we like Tega, especially within the mining line spaces, because of its technology. For example, Tega has been one of the rare companies which has been able to develop lining, which is a combination of both metal as well as polymer. These are actually different products, but Tega has found a way of actually fusing uh, polymer with metal. In fact, it's called Dyna range line of mill liners. And this product has really taken off in the last 3 to 4 years. It has found very strong application, particularly in larger mills, especially in Chile. And we think that this, especially this Dyna range of mill liners, the poly net range of mill liners, this gives enormous advantages to Tega. And thirdly, Tega also has operations in the local operations. So that gives a lot of comfort to the customers, because if there is some problem, you have somebody locally who can come, who can provide support. While over the course of last this decade, these operations actually didn't do well for Tega. In fact, these operations struggled initially. So many of these were acquired between 2005 to 2012. This took time, but we have seen that over the course of last 4 to 5 years, these operations have stabilized, and many of these subsidiaries, which were erstwhile making big losses, now actually have become a very good profit contributor to Tega. So operations, etc., is also very, very stabilized.
Just to make
So we
just
think
make one
again,
just one point here.
sure.
So folks, RHI Magnesita's core refractory product is used primarily in the steel industry, right? So RHI's core product is used in the steel industry through acquisitions, the Dalmia acquisition in particular. RHI is also getting into the cement industry. So RHI's core application, the refractory, is going to steel furnaces, and through acquisitions, RHI has entered the cement furnaces as well. Tega's mill liners go into the copper and gold industry, right? And as Ashwin has said, this goes into copper and gold globally. That this is the number 4 player globally, and the only player with Tega is the only player in the world with mill liners which are both metal and rubber. And as Ashwin explained, this is a branded. This is actually a patented product. The patent is owned by Tega. Now Tega's fortunes obviously will have a linkage to copper and gold prices. At the moment, copper and gold prices are doing just fine. And it seems like the next wave across the world, the next wave of copper and gold capex has begun in mines, and that should serve Tega in great stead. And similarly, in RHI's case, as I'm sure all of you are reading in the newspapers, India's steel plants are operating at 90% capacity. Steel volume growth in India is mid-teens, and therefore, the next wave of steel capex, the next wave of steel plants, whether it's Tata or JSW or Steel Authority, whoever puts up the next wave of steel plants, that will trigger more business for RHI, right? So you can see that we're basically buying moated plays. We're buying moated plays on the capex cycle, both in India and across the world. Back to you, Ashwin.
Thanks, sir. The next company is Everest Industries. It's a fairly old company, almost closing in on 100 years of existence. But what has changed in the company is that two things. One is that for the most part of its life, it used to be a subsidiary of ACC. However, it was acquired by Sheikh Sharia family in 2013. So there's a new set of promoters who have come in. And second set of change which has happened is the entire leadership has underwent significant changes in the last 3 to 4 years. For example, the top CXOs have come from Cummins. Chairman of the company, Mr. Taulikar, has spent significant amount of his career in Cummins. The current CEO of the company, Mr. Joshi, he comes from Pidilite background. So there is a significant change in the leadership which has happened. They have come from top-notch companies, and we think that this can actually change the fortunes of the company as we go ahead. So Everest is present into three segments. One is their cash cow roofing business. So this is nothing but the asbestos roofs. It's a fairly stable business, growing at a stable rate. Good ROCs made by the company. Only thing is that the last 2 years have been tough for the asbestos-based roofing companies, primarily because of the asbestos globally. Russia is a big supplier of asbestos, and because of the Russia-Ukraine war, etc., the asbestos prices went through the roof. Otherwise, historically, this has been a very stable ROC, stable volume growth segment. But again, here we are seeing the prices correcting, and as we head ahead, we think that it should be back to the good old days. But more importantly, where we are betting for Everest is on the cement fiber board segment. So this is nothing but a product board which is made out of cement and pulp, and this is finding more and more application, especially since the onset of the COVID. The reason why this is finding more traction and application is that because it can be constructed, it can be actually, the construction can be done at a very, very rapid pace. You have to all do is that get the prefabricated CFB, put it into place. So you don't need to have too much of labor. So labor has been a big problem, especially in the construction industry. And during COVID, it was a big problem. So this provides solution to the labor shortage. And another problem has been, for example, many of you must have heard the persistent news around sand shortage, etc., which is impacting the construction. And because the cement fiber board doesn't use sand, again, that solves the problem. So we are finding increasing adoption of CFB. COVID was a catalyst, but this can really continue on its growth path. And as we speak today, still like the penetration of CFB is still very, very low. I think there is a very big headroom for the CFB penetration in the construction industry. And Everest itself is trying to increase the adoption. It is trying to do the Architect Connect, which is a very big influencer in this space, coming up with very, very innovative products. So CFB is a big bet, I think, where we are banking on in case of Everest. And the company is also doing, since the new leadership has come in, there is also the R&D engine which has set in place for Everest. For example, within the old asbestos-based products, they are coming up with innovative products like Evercool, which significantly brings down the temperature. And this finds very good application, particularly in poultry industry, etc., where temperature can play havoc with the lives of poultry. So, for example, Evercool is finding increasing traction in that industry. And in the CFB, again, to gain market share, and secondly, more importantly, to drive the adoption, the company is also coming up very, very interesting designs and value-added products in the CFB space. So again, here we are betting. We think that a company has significant potential to grow its earnings, thanks to both the new leadership coming in and their pedigree, as well as the things which we are seeing in the company in terms of inputs into R&D, in terms of product design, etc. That has been happening in the last 2 to 3 years. One company which we added is Control Print, fairly stable company, very, very stable ROCs, stable, healthy earnings growth through its history. Control Print actually supplies printers and ink consumables to the coding and marking segment. So this is nothing but you must have observed in many of the products there is a variable information which is printed. For example, what is the manufacturing date, what is the batch number, etc. So Control Print supplies both the printers to print this information as well as the ink to print this information. And while it may sound very, very simple, but this is a very difficult product, because you have to apply this product on various range of surfaces, right from, say, a flexible product like pipes to a very hard product like plywood. And this ink can't actually fade because this is a regulatory requirement. For example, if the batch number or the manufacturing date fades, you actually can't sell the product. You have to get again, bring back the product, print it again. And there's a lot of science which is there behind this ink because it has to bind onto the particular surface. There's a lot of customization depending on the surface, depending upon the product, whether it is a polymer based product, whether it's a wood based product, or it's a rubber based, or it's a another type of product. As a result, this industry has only handful of names. So there is Control Print on one hand, which is all in all Indian company. On the other hand, there is a MNC players which are only there, likes of Videojet, likes of MR, Markem, likes of Domino. Very strong moated industry. And why we like Control Print within that is that Control Print especially is growing very well in the industrial segment. So historically, Control Print used to be a distributor of Videojet. The distribution ended somewhere around 15 years back. Then Control Print ventured on its own. It got its technological know-how from companies like KBA from Germany. And it has been growing very well in the industrial space because in case of FMCG, because Videojet may be dealing with HUL or the Unilever at the global level, the entry there is a bit difficult. But the industrial players who are largely Indian, they are more open to experimenting with the likes of Control Print. And industrial has been the calling card for success for Control Print. They have been able to make good inroads in cable spaces, in the plywood spaces, etc. And these are the segments which are growing much faster in the overall space. The industry sector is fairly stable, and because it is largely dominated by the MNC players, the pricing is also very, very stable. There is no pricing war which happens in the industry, and that has also lended itself to the stability in the ROC margins and the growth rate that we see in the space. So Control Print we have bought basis that reason. Another company which I bought is Ami Organics. So why we like Ami Organics is because it has not wedded itself to a particular chemistry. So in chemicals, you'll find that a company generally specializes in one set of chemistry, whether it is say an amines chemistry, which is case of alkyl, or fluorine chemistry, or a Grignard chemistry, case of Ami Organics has built capability across a wide chemistry skill set. And what has that enabled company is to build a very granular level of customer base because it is not stake its fortune on particular chemistry. It has been able to build a wide set of end user segment, wide set of customers. And Ami has been one of the calling card for any company which is going off the patent. So during patent, actually the cost doesn't matter, but once you go off patent, cost becomes a very, very important calling card. And Ami has been specifically be able to target those molecules which are going off patent. And it has been able to build a very good relationship with global players like Fermion, etc. And more importantly, we think that Amis also added many growth drivers into its business besides the core intermediates. For example, specialty segments, it acquired a company called Gujarat Organics. And by acquiring that company, it got an entry into specialty chemicals like paraben, etc., which is a big volume segment. The company is also, Amis also acquired a company called Baba Fine Chemicals, which supplies niche semiconductor chemicals. So this is very, very tough product. Baba makes something like 50% EBITDA margin. Very, very niche, but very technologically intensive product. And Ami has been able to has acquired Baba Fine Chemicals, and we believe that it can scale up this business. There are not many players in the world actually which makes this semiconductor chemicals. Third important segment which it is entered into is EV battery electrolyte additives. Again, very, very handful number of players which will be able to crack this space, and Ami has been is one. And as the electric vehicle keeps on finding more and more traction over the course of next 5 to 10 years, I think that helps, that puts Ami in a very good space. And recently, it has also started manufacturing the electrolyte solution itself. So the earlier one was electrolyte additives, very, very niche, but this is the electrolyte solution. I think company has not disclosed the name of the player. So I think they're starting a JV with that player, I think based out of, I think, a very important player. But more importantly, this can also add significantly to the revenues of the company over the course of next 3 to 4 years. In other words, we think that Ami's core products, the intermediate products itself, can fire. They are deepening the relationship with customers like Fermion, etc. in that space. Got recently important orders in some of the important molecules. But also it is entering into new segments and building very good growth drivers over here. So next 2 to 3 years, 4 years, 5 years can be very good for Ami Organics. And the last two companies which I'll quickly understand we are running out of time is Shanti Gears. Again, has been present for decades, but what has changed in the company is that around 10 years back it was acquired by Murugappa Group. And through after acquisition for Murugappa Group, we have seen important changes which has happened in the company. One is that Shanti has always been known for its engineering prowess. The earlier promoter used to be a technocrat. Shanti always was the calling card for customized gears. Gears are a very important components in a manufacturing setup, right? Gears, it is because of the gears that things move from down the assembly line. So it's an important product. There's a lot of design, precision engineering which goes into that. There's a lot of customization which also happens depending upon the load capability, the pace of the movement that you need to do, alignment with the other components in the assembly line. Shanti has always been known for its engineering capabilities. But what was missing in the story was that the operations were not run with very high degree of efficiency. And with Murugappa and especially with Mr. Velayan coming into the picture in the last 3 to 4 years, we have seen a lot of improvement in the operational piece. For example, similar to what has happened in tube investments in CG Power, etc. A lot of important initiatives like TPS, etc. have found a place in Shanti Gears. They also brought down the working capital significantly through initiatives like channel financing. For example, the working capital cycle, which used to be north of 100 days 3 4 years back, that has come down to 60 days. Very, very important initiatives. But also, what we think will aid the growth is Shanti, because of its focus on customization, very high engineering. It was not having significant presence in the catalog gears. So if you look at the gears market, almost 75% is catalog and 25% is customization. Historically, because of its product focus, the company is largely present in only in the 25% pie of the market. And after TI taking over, and especially in the last 4 to 5 years, the company is also targeting catalog gears, which is 75% of the market, and it is finding good traction in that space. For example, Alicon is the market leader in that space. Shanti is also trying to make inroads in that big space, which hitherto it was absent. And another piece which the company is focusing is also on the exports. So export again globally, gears, a lot of big export market like US. Again, because of the bandwidth or other issues, the company is not focusing so far. But in the last 2 to 3 years, it is also focusing on the export market. And I think over the course of next 4 to 5 years, this can be an important growth drivers for Shanti. So again, here we think both because of the cyclical upturn, because of the capex, etc., but more importantly, also the company undertaking new initiatives. The company should do well over the course of next 4 to 5 years. And the most recent company which we added is City Union Bank. Again, a very long-standing bank. The company didn't have the best of the time over the course of last 1 to 2 years because of some specific issues. We think that issues are behind it, and the bank should make very good use of the macro tailwinds, especially in the South India that we are seeing so much capex which is happening. The company should benefit from it over the course of next 2 years. CUBK has always been known for its asset quality. It's one of the, I'd say, the top 5 banks in terms of the asset quality. So asset quality, they have always been known. The liability franchise is also very, very strong. because has there's a lot of loyalty of a particular community, which is there, both in terms of the management as well as in terms of deposits. So it always had a very solid liability franchise. The only piece missing in the puzzle was growth because of some company specific issues, which we think is behind it, and hence we should see a growth coming back for City Union Bank. The company is also undertaking a leadership change. I think a successor should be appointed in due course. That should also take away some overhang which is there on the stock. So again, CUBK, we think that should do well as we go forward. I think we finish here the discussion on the new. In summary, we think that new additions which we have made in the portfolio, they should deliver very healthy earnings growth for the course of next 2 to 3 years. And many of the long-standing holdings which didn't have a very great run in the last 1.5 to 2 years, it should see a revival in earnings. We have discussed some of these names over here. Thirdly, as I said, like FY25, we also will have a base effect, favorable base effect, which should come into the play. And the fourth point is, as Saurabh said, many of these companies did very well in FY21, FY22. They generated a lot of surplus. These companies reinvested a lot of the surplus back in the balance sheet into the company. For example, course of FY22 to 23, the average annual investment of these companies was twice than what used to be pre-COVID, FY19 to 21 period. So many of this reinvestment, because of the weak demand, etc., we are not seeing the benefits of that flowing through in the financials. But as things normalize, as demand normalize, this reinvestment should also come into the picture. And we are already seeing, as I said, green shoots of recovery, especially in the export demand for many of these companies in the recent months, especially since November. In all, we are very, very confident that the earnings picture of the portfolio should look completely different than what it has been over the last 3-4 quarters. I think I'll stop here. I think we can start the Q&A.
Okay, thanks, Saurabh. Thanks, Ashwin. We'll start with some of the more strategy-oriented questions before getting to some of the stock-specific questions. One is in terms of learning. Is there some learning to be had in terms of in having seen those disproportionate earnings growth during COVID? Should that have been a cue to trim or sell the position? Or would we still continue to hold conviction if we see that sort of a situation again and reinvest profits for the long run?
Yeah, so let's focus on the ones that we have sold, right? Because the ones that we have held on, we believe we did the right thing by holding on to them. Do you mind going to the slides on GMM and Tarson's and Fine and so on? So the ones that we have held on, these companies made inordinate profits. You can hear me, right?
Yes, yes.
Yeah. So the ones that we have held on, these companies made inordinate profits through COVID. And as I was explaining earlier just put it in show mode, Ashwin. Not this one, the ones, the slides where you showed FY21, 22, one by year profits for Tarson's and GMM and so on. So just go there. So just to stress again, right? If you take and just put it in show mode, Ashwin. So if you take a Tarson's or an Alkyl, if you look at 15 to 20, these companies are grinding out profits at a steady rate. Then you have the 2 years of COVID. In Alkyl's case, actually just 1 year. And there was no reason for us to believe then, and still no reason for us to believe now, that the 15 to 20 track record of steady profit growth is not going to be repeated, right? So that's the first thing, that even if we had perfect foresight on the future and said we know that COVID will end with the second wave in September 21. Even if we had that perfect foresight that September 21 COVID khatam ho jayega, it will never come back again. Logic would have told us that the past, which is Tarson's past of 32% PAT compounding, 15 to 20, or Alkyl's past will occur again, and we would hold on. And even now we have that view, which is why Tarson's, Alkyl. Just go to the next slide, Ashwin. A Tarson's, Alkyl, or a fine organics. Ashwin, let's put this in show mode and go into the next slide.
Okay, I think.
Maybe there's a lag. Anyway, so not this one, the one prior to this, right? So where
Just
so yeah, I think there's a bit of a lag happening. Anyway, so where we believe that the company's future will be good, we've held on, and yes, we've gone through 1.5 years of hammering on profit degrowth last 9 months. A Tarson's, a GMM, uh, 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 a Fine Organics has degrown profits, but I think that's a necessary part and parcel of life in small cap investing. If you are invested with us in small caps and you don't have the appetite, or we don't have the appetite of 9 months of degrowth, uh, we don't have the appetite of 9 months of degrowth, then I don't think small cap investing is your or my cup of tea. We will have periods of degrowth in the profitability of even the best small caps. Now let's look at the ones that we've sold, right? That's where I think our bigger screw up happened. Uh, I would put the exits into two buckets: exits which are not related to China and exits which are related to China. So exits which are not related to China, I would say Amrutanjan and Vmart, right? So those are two exits which have nothing to do with China. Vmart we should have figured out earlier, especially since we were doing all the work that we did on Trent, and we loaded up on Trent through the summer of 2023, and we then doubled the position in the winter of around Diwali 23. As we were doing the work on Trent and we were seeing how powerful a machine Zudio was being built, the penny I think should have dropped on us sooner. The penny should have dropped on us sooner that Reliance Trends and Zudio are taking market share from someone, and that someone I think we should have figured out much sooner is Vmart. So Vmart is one case where we saw their weakness through the COVID months, and we said, "Arey, ye to COVID hai." Then they came out of COVID and they were still weak, and we said this is the K-shaped recovery. And it took us, I think, far too long, Pramod. It took us far too long for us to clock that Vmart is losing share to two powerful competitors, one from the Reliance empire and one from the Tata empire, right? Amrutanjan overearned through COVID as everybody sat at home and applied balm copiously. Amrutanjan history is decent, but unlike I think just go to the slide 7, Ashwin. Unlike a GMM or a Alkyl or a Fine Organics, and Amrutanjan is not a 30% profit compounder, wasn't pre-COVID, right? Amrutanjan is a steady, solid firm, but it was never a 30% profit compounder in the pre-COVID era. I guess the screen is frozen solid for some reason. Anyway, so Amrutanjan was not a strong profit compounder. It's a decent, it was like a high teens profit compounder. So therefore, in Amrutanjan's case, when the COVID overearning happened, we should have got out on the back of that, right? And I think the third non-COVID exit is Home First. Thankfully, in Home First, we learned the lesson. The housing finance market was doing exceedingly well. Home First's price to book multiple was approaching, I think, 4.5. Home First and Bajaj Finance were trading at the same price to book multiple around Diwali last year. And having made a good return on Home First, having seen Home First reach Bajaj Finance style price to multiples. Remember, Home First and Bajaj Finance in no real world situation should be at comparable price to book multiples. Bajaj Finance is a machine with extraordinarily low cost of capital, with deep comparative advantages in data analytics. Home First is a well-run, affordable housing finance company. So when we saw that a small, well-run player like Home First was approaching price to book multiples of the champion in the sector, we decided to check out. Now, these three exit, two I think we got wrong. We should have exited Vmart and Amrutanjan quicker. We should have been quicker on the uptake on Vmart the structural market share loss to Trent um, and Reliance Retail. And in Amrutanjan, we should have been quicker to understand the COVID over-earning. Home First, we got right. Now let's come to the China related the China related damage, right? So there, the only exit has been the only China related exit has been Poshak, and in Poshak's case, I think we misunderstood the mode. So just to step back on Poshak, Poshak is the manufacturer of phosgene derivatives. Phosgene is a controlled substance. It's the substance of the Bhopal gas tragedy, and hence the government very tightly regulates who has licenses to make phosgene and who doesn't. Poshak has a license. When we bought it, they had just doubled capacity just prior to COVID, and we expected it to make money through COVID as they grew into their capacity. They made some money through COVID. When COVID ended and, and the world unlocked again, phosgene derivatives from China started entering the market. And I think there we have to confess, we misunderstood, right? Ashwin and I misunderstood the moat. Yes, nobody else in India in the private sector exclusively makes phosgene derivatives. But whilst phosgene itself can't be transported across long distances because it's highly toxic, whilst phosgene itself can't be transported across long distances, phosgene derivatives can be. And then once COVID ended, China smashed the prices of phosgene derivatives in India. Phosgene derivatives are used for agrochemicals. And I think we misunderstood the moat there. Because we misunderstood the moat, through COVID, we were fine. Remember, COVID insulated India from Chinese competition for a variety of reasons. Ports were shut in China, containers were in short supply. But as soon as COVID ended, the fact that in phosgene derivatives it's impossible to have a moat was, I think, exposed. So Poshak was in a way, China dumping related exit, but I think the Chinese dumping there underscored the weakness of the moat. The ones that we have held on to, the stocks in slide 6 and 7, the ones that we have held on to, slide 6 and 7, there we believe the COVID excessive earnings have been reinvested in new plant and capacity, and the FY24 pounding, FY24 pounding in PAT should reverse in 25-26. So looking back, Amrutanjan, we should have got out quicker. Vmart, we should have understood the comparative challenges quicker. Poshak, we should have understood the, again, China related challenges quicker. But in firms like Fine Organics, GMM Fodler, Tarson's, it's much harder for other people to enter. Alkylamine, sorry, fourth name on that list would be alkylamine. It's much harder for someone else to come and enter and take over that space. In addition, my reading is after the elections are done, after the general elections are done, my reading is there will be anti-dumping interventions by the government of India. We've seen that in other sectors, right? Sectors like semiconductors, the government has used the PLI scheme to support Indian manufacturers. The whole electronic manufacturing services industry is growing on the back of government support. Similarly, we've seen that in other sectors where the Chinese have dumped historically, tires, for example, the government has been prompt in protecting Indian manufacturers. My reading is after the elections are done, we will see anti-dumping intervention by the government of India. We're not waiting for that. We're focusing on the fact that Alkyl's market share, Tarson's market share, Fine Organics' market share, GMM Fodler's market shares are intact. And we can also see, as you can on the screen, the 15 to 20 profit compounding track record of solid profitability growth across long periods of time. So there are mistakes we made on what should I say? What's the word? The mistakes we made on exits we should have made earlier. And then there are other companies which have cost us in terms of PAT compounding, where we don't, whilst we're not happy that they cost us in terms of PAT compounding, we understand that that's the nature of the beast. That's the nature of small cap compounding, that if you can't sit through a period like what we are seeing in the screen for alkylamines or tarsons, then I'm afraid, we can't do small cap investing if we can't live through this sort of pain.
Great. So you actually sort of answered my next question around the Chinese dumping issue. But I guess there's a question from a client, which is, let's assume, given the nature of the status of the Chinese economy, this could continue for far too long. There could be excess inventory. Should the anti-dumping measures not come, how would we, or how long do we sustain?
So I think people are absolutely right in fearing that the Chinese dumping could continue, and it probably could continue, probably will continue. I think let's use the word will. So two sources of relief, I think, should be around the corner. One is just like the government, remember India's specialty chemicals industry got wiped out between 1995 to basically 2015. India's specialty chemical industry pretty much got wiped out by exactly this, by Chinese dumping. Back in the 80s, I was in school then, but when we speak to people in the pharma industry, they say that in the 70s and 80s, India used to make the API intermediates, but then China killed our intermediates industry. When China entered the global trading system, they just dumped intermediates on the whole world, and India's API intermediates industry was wiped out. Now, I doubt the government of India would want a replay of that, right? Somehow, through a lot of hard work in the last 7, 8 years, these companies that Ashwin is flashing up on the screen for the last 7, 8 years, through a lot of hard work, these companies have risen from being tiny little companies 10 years ago to being $1 billion market cap companies, Alkyl and GMM. I don't think the government will want a replay of the Chinese hammering our specialty chemicals industry out of sight again, uh, uh, much as the Chinese would want to do it because of their economic woes. So, relief one, I think there will be anti-dumping intervention after the elections. Why aren't they doing it before the elections? Because these things feed into the price of pharmaceutical products. I don't think a politician's life is made easier going into elections if the prices of essential medicines are shooting up. Second thing is the Western economies, where there's a lot of chemical demand. Usually, the Western economies are recovering, as I'm sure all of you read in the newspapers. The rate cycle in the West seems about to turn. The Federal Reserve itself is saying it's not very far away from rate cuts. Plus, GDP growth in the United States at least is at pretty healthy levels. United States itself is going through a cycle of make in America, rather than being reliant on China for every single thing. Americans want to make stuff at home. So the revival of the industrial cycle in the United States specifically, uh, and the revival of the beginning of the rate cutting cycle should lead to chemical demand picking up in the Western world. And as Ashwin is saying, right, if you look at India's export data through Jan Feb, we can see that the exports by these companies into Western markets have picked up again. So those are the two sources of relief that we are banking on: anti-dumping intervention by the government of India, and revival in export demand from India to the Western markets for these companies. And the Chinese will do what they'll do given the blighted state of their economy.
Right. Again, sticking to chemicals, from a learning perspective, how do we see diversification sectorally? Do we see an overexposure to specialty chemicals as a cause? Would we do this in future again?
Yeah, I think there's two different learnings there. I think a good question by the client who's asked this. So remember, till 1.5 years ago, this was a 15 stock portfolio, right? LCP was a 15 stock portfolio, and those 15 stocks were by definition discoveries that we made through 2019 and 2020. Those discoveries did well through 2021, and all the way to October 22, we were fine, right? We were a 15 stock portfolio even in October 22. And then what followed was a two-part disaster, right? One was some non-China related plays, such as Amritanjan, such as Bmart, had challenges with their underlying demand, and then a whole clutch of chemical related plays got pounded by China. China began its dumping in earnest in May last year. May 22 to October 22 was the peak of Chinese dumping. 40, 50, 60, 70% price cuts in chemical products. So effectively, more than half of the portfolio saw profits dropping through most of 2022, right? And I think there is a lesson there that if you're going to run a 15 stock portfolio, by definition, small cap companies, market cap of 6, 7,000 crores, if you're going to be that tight, if the portfolio is going to be that compact, 15 stocks, and if half the company's profits are going to go down, then obviously the portfolio is going to get thrashed. And as a result, as what we have done in the last 8 months is brought in new stocks and made it a 25 stock portfolio, right? By reducing the sector concentration, by increasing the number of stocks and reducing the sector concentration, we have tried to reduce the chances of a replay that once again a Chinese equivalent happens and half the portfolio's profits get wiped out. So the new stocks that Ashwin took you through, right? You see they come from a plethora of sectors. City Union Bank is a small cap bank in the most prosperous part of India. Ashanti Gears is doing something completely different in the most prosperous part of India. Taga is catering to the global market for mill liners. in the gold and copper industry, and RHI Magnesita caters to the steel industry in our country. A PDS is about taking apparel from Bangladesh to the Western world. So we've tried to build in diversity in the portfolio, increase the number of sectors, and increase the number of stocks. We'd have loved to do this earlier, but we simply did not have clean financials for FY21 or 22. Not until the FY23 results came out did we have the chance to discover new stocks. But I think, Pramod, the client makes a fair point that had we not been beaten up like this by China, perhaps we wouldn't have diversified the portfolio.
Right. So as a extension of a similar question, the sectoral diversification is quite evident. But going from 15 to 25 stocks, what's the thought process behind that? We had, sort of advocated concentrated portfolios. I mean, 25 is still concentrated. It's not like we're buying hundreds
I think
of.
there's two parts to it. One is just liquidity, right? So as Marcellus grew, as the fund grew, by 2022, Ashwin and the traders were finding it incredibly difficult even to sell 5-6 crores or buy 5-6 crores. So as the size of the fund grew, getting in and out of positions any more than say 5-6% of the shares outstanding in the fund, or getting in and out of positions any more than 5-6% of the value of the portfolio became very difficult. So just the practicality of buying and selling shares necessitated that we consider not a 15 stock portfolio but a 20 stock portfolio, because otherwise it was becoming impossible to trade without creating massive price impact. That's just a practical challenge that we encountered as the size of our firm and as the size of the portfolio grew. And the second reason was as the research team also got settled in, as the research team that we had hired through 2019, 2020, 2021 settled in, our ability to cover more stocks, research more sectors grew. So over the last 8 months, we would have bought 10 new stocks. And there's 5 analysts who are almost intensively working on small cap discovery. We didn't have this privilege in 2019. Thankfully, in 2019, we neither had this burden of AUM and liquidity impact to deal with. So both the liquidity challenges that we faced through 2022-23 made us realize that we needed to broaden out the fund to avoid creating massive price impact every time we bought and sold something. And secondly, the realization that we both had the corporate access and the research talent to build a broader portfolio. I don't think Ashwin's knowledge or my knowledge of the 25 stocks in Little Champs is any shallower than our knowledge of the original 15. Out of the original 15, roughly 10 are still there. So effectively, there's 15 new stocks that we've had to understood, and we've had good year and a half to learn about those 15 stocks, research them intensively, and build the positions.
Fair enough. On the sectoral diversification piece, client has clearly noticed that the benchmark has done well because a whole host of new sectors, particularly in manufacturing, exposed to being beneficiaries of PLI or government capex or defense capex or railway capex, and all have done well, which clearly we've sort of stayed away from. The question is, any thoughts on why we've stayed away from, or do we expect to, are we doing any work on those areas?
Right. So part of the reason is, as we've seen in the budget already, right? The union, the full budget will be announced on the other side of the election. The vote on account that the FM announced on 1st February, Pramod. The FM has clearly said that government capex has throttled off meaningfully. So just for those who've been keeping an eye on numbers, the FY 20, 21, 22, FY 21, 22, 23, 3 union budgets in a row, government capex rose by around 30%. So effectively, government capex doubled in over the course of 3 years, right? In the budget that the vote on account that the FM announced on 1st February this year, the government capex grew by 11%. So the party, for those people who are if you're investing in stocks where the main source of demand is government capex or government contracts, I think the party is by and large behind us. And rightfully, the government of India stepped on the capex accelerator through 21, 22, 23 because they realized private sector capex was completely dropping off after COVID. So the government reinvigorated the economy through government capex, and the contractors to the government benefited from that. We stayed away from that because it feels to us to be a short-term story. And as the FM has already announced in the first February budget, government capex growth has throttled off meaningfully. The government says so, we can see so that private sector capex is picking up. So if you want to see private sector capex, go to Hosur in Tamil Nadu, go to Coimbatore in Tamil Nadu, speak to companies in the southern Indian belt, or speak to companies in Gujarat, say go to Rajkot, you'll see private sector capex revving into high gear. And what we have tried to do is buy in the portfolio stocks which benefit from private sector capex, right? So, for example, as steel demand is blasting through the roof, it's evident in the government data that steel demand is going through the roof. Tega is a natural beneficiary. An RHI Magnesita is a natural beneficiary of that. Similarly, as copper demand picks up around the world, an RHI Magnesita will benefit from that. Shanti Gear should benefit from the gear capex. Shanti is the second largest player. It's not the largest player, but Shanti is the most technologically adept player in the gear industry. But I think by some distance, Shanti Gears is the most technologically adept player. So we should see the private sector capex kicking into life nicely over the next 2 to 3 years, and we've bought companies to benefit from that. I'm not so sure the government capex pieces is as sustainable as a lot of people have assumed it to be when they have bought shares based on companies who benefit from government capex.
Fair enough. On the discovery element, a few people have asked the question that, look, a lot of the new stocks, it's not like they've just been discovered. They've also come in after a period of run-up. How do we explain what is the discovery left in these stocks?
Let's take it step by step. When we bought Everest 4 months ago, Everest was a loss-making company. So I could see the shareholder base. I don't think there was, barring us, I think there was just one other institutional investor in the Everest Industries shareholder base, and partly for good reason. I don't think there are too many institutional investors in India who have the stomach to buy a loss-making company. Thankfully, Everest Industries has turned profitable since then. So that's a straightforward example of pure discovery, right? This barring us, no other institutional investor was on the shareholder roster when we got in, and it was a loss-making company, albeit in a market-leading position. Our call was it would become profitable. Thankfully, it's become profitable, and we hope that Everest Industries' profitability will grow leaps and bounds in the quarters to come. So the Everest is a classical pure discovery type name. But let's take something else which someone will say is not pure discovery. City Union Bank has been literally around for 110 years. Pramod, you and I in our previous avatar have raised money for City Union Bank. But to my mind, City Union Bank also counts as discovery because the conventional view on City Union Bank was that, hey, this is a run-of-the-mill bank in Tamil Nadu. It's had problems with RBI. What future does it have? Its technology is weak and so on. That was the conventional view. Our work suggested quite the contrary. We visited plenty of branches. We met City Union Bank's customers. We met their competitors. Some of City Union Bank's most powerful competitors said it is impossible to price away City Union Bank customers. Loyalty, as Ashwin mentioned, loyalty is immense, especially in Tamil Nadu. Loyalty to CUBK is immense. The technology we found was very good. We found dramatic advances in branch level technology in CUBK's case. Our work on the ground of traveling around Tamil Nadu suggested a meaningful jump in City Union Bank's growth prospects. And to our mind, this is also discovery. Just because the company's been around for 110 years doesn't mean the stock market understands it fully. If anybody on this call goes and reads the sell side research on City Union Bank, you'll realize that none of the points I've mentioned in the last 3 minutes are covered in the sell side research. The stock was trading at 1.1 times with a well-capitalized balance sheet, a strong franchise in one of India's most prosperous states. And to our mind, that's also discovery. Now let's do the third type of stock, right? A company like Control Print. So people will say, well, Control Print has run up and Marcellus has bought it after the run up. If you look at our acquisition price on Control Print, it's well below the overall PE multiple of the portfolio. The PE multiple of the portfolio, as Ashwin has shown you, the PE multiple of the portfolio, as Ashwin has shown you, is not particularly above, not far above the BSE small cap PE multiple. And we bought Control Print at a valuation almost half of that of the uh, of the portfolio PE multiple. Could we have bought control print sooner? I don't think so. We need to see. We need to see happy customers of that company. We need to have extensive discussions with the customers of the company. We need to meet large, credible customers, whether it is for Tega, whether it is for Shanti Gears, whether it is for Control Print. We need to see large, credible customers who sit down with us and give us proof of concept and visibility that this company, whether it is Tega, Shanti Gears, Control Print, we need to see large, credible customers, BSE 500 companies telling us that this company's product is good. We've given them X amount of business. We foresee giving them 3x amount of business in the coming years, right? So we did the work on Control Print. When we felt satisfied with the depth of research done by the team, we went and bought it at what we think is was a very attractive valuation. Yes, it had run up by then, but if on that pretext that you shouldn't buy shares that are running up, then the only shares you can buy are running down. And I'm not so sure Little Champs will be doing discovery if we just keep buying shares that are going downwards.
Fair enough. Just continuing with valuation, there's a question around, we've talked about incorporating longevity. And to that extent, how do we see longevity in small cap companies like these?
Ashwin, do you want to take that? I think you've run some analysis on that. I think you have some data on that as well. How much longevity is baked into the portfolio? And it's an interesting question. And I think it's a good question, actually. Let's get into that.
Yeah. So basically, yes, we showed the current price to earnings multiple of the portfolio is around 30.5 odds. So if you assume a growth rate of 20%, earnings growth rate of 20%, which historically Little Champs have delivered for a long period of time, if you take a cost of capital of 12% and a terminal growth rate of 5%, all that the 30.5 is implying is that these companies will compound only for 20% for 7 years, and then the growth rate will fade to 5% forever. So only 7 years of 20% growth is all that is implied by 30.5 current P multiple. So which we think is significantly
we're on the wrong side. We're looking at a slide saying assess earnings growth prospects of current holdings. So maybe just to refresh the screen so that we can
I think you might want to stop sharing and reshare again. Sometimes it freezes.
Sorry about that. So let me see. I should have something.
Or rather, let me try. Actually, I've got the deck. Just hold on. I'll try.
Yeah. I think this is.
Yeah, let me try.
Can you see the slide?
Yeah.
No.
Low longevity implies.
So this is what.
Yeah, got it. Yeah. Go on, Ashwin.
Yeah. So this is what I was telling. So what does P multiple of 30 implies? So assuming a growth rate of 20%, FCF or PAT growth of 20%, 21%, a terminal cost of capital of 12%, a terminal growth of 5%. This is all that is implied by 30 times P multiple, 7 years, which we think significantly underestimates the compounding, the growth as well as the longevity of that growth for the Little Champs. Just for context, Little Champs, even though some companies may be younger, but the average life of these companies would be at least 15 years, and they would have compounded historically 20% for at least 15 years. So market is currently believing that it will that longevity will be only half of what historically these companies have been able to sustain.
Right, and there's a question specific to comparison with our, say, CCP portfolio. How do we see longevity differently?
Sure. So let me do
painted a scenario. If you use DCF, say what percentage of the value comes from the free cash flows over the next 5 years? What percentage is it for LCP companies? What percentage is it for a CCP companies? They're like a...
Let's do the math. So Nifty, let's start with the Nifty first. Nifty P is around 21, right? Nifty P is around 21. the ROCE of a typical Nifty company is around 15%, right? 15%, perhaps a little lower, but let's keep it simple at 15%. CCP's P is 38. So Nifty 21, CCP 38, right? So CCP's P is less than 2x that. So it's roughly 1.8x. CCP's P multiple is 1.8x that of the Nifty. CCP's ROCE, however, is 30% plus. So CCP is giving you twice the ROCE. CCP is giving you twice the ROCE for less than twice the PE. So CCP is giving you twice the ROCE for less than twice the PE. Now, if you put that in a DCF, if you take a company with 38 times earnings and put that in a DCF, you need around 13, 14 years of longevity. You'll need around 13 years of longevity to justify the share price. What do we mean by 13 years of longevity? You'll need 13 years of free cash flow growth around 20% to justify the valuation. Thereafter, you'll have a terminal growth of 5%. So for a CCP company, you'll need 13 years of 20% growth, 21% free cash flow growth, and thereafter a perpetuity of 5 to justify the current value. And if you wanted to break up what percentage of that, so the first 13 years of a CCP company will be 70-75% of the value of the company, right? So CCP at P multiple of 38, and therefore you need 13-14 years of good free cash flow growth, 20-21%, and that's the core, that's the spine of your valuation. In LCP's case, this is at 30 times earnings. As Ashwin is saying, if you grow at 21% for 7 years and thereafter a perpetuity of 5, you get to the DCF value. So effectively FY 25 to FY 31, FY 25 to 32. The years between now and FY 32 is 3/4 of the value of this sort of firm. And after FY 32, you're basically on a perpetuity mode, right? In the context of investing in companies with ROCEs around the 25% mark, ROCEs for this portfolio for LCP are around the 25% mark. CCP ROCEs are much higher, they're 30-35%, but let's focus on LCP. In the context of investing in small companies, remember 7,000, 6,000, 7,000 crore companies with 25% ROCEs in niche industries, if we can't identify companies which can grow at 20 odd percent for the next 7 years, then honestly, there's no point trying to do this, right? Because I don't think we will claim to be bright enough to buy small caps for 2 years, trade out of them, buy the next bunch of small caps, trade out of them. It's simply too hard to do. So when you're able to find companies around the 3,000, 4,000, 5,000 mark, and you can see that they have got a good ROCE, 25%, they're reinvesting pretty much all of it back into the business. That gives you visibility on a growth engine at around the 20% mark. All you need is for that to run for 6-7 years, and you'll be able to get the valuation that you seek from that company.
Fair enough. There's a practical question, given that on the one hand, LCP hasn't done well, both absolute terms and relative terms, at least in the last couple of years. On the other hand, you have small caps sort of breaking in the market. What would you recommend an investor, say, who's convinced on LCP in terms of when they should invest? Should they put in the money now, saying that LCP hasn't participated, or should they wait for the broader small cap correction? Hopefully it has begun, assuming it's going to continue. Wait for that to settle down, given LCP will also participate in that sort of a drawdown. Or corollary to that question, instead, if they have 100 rupees spare to invest, should they rather invest in CCP and not participate in the small cap drawdown at all?
Sure. So let's answer the first question first. Should you invest in LCP in isolation? Then the relative question, right? The relative is the harder question. Ashwin, can we go back to the first slide in your deck? Right. So the first slide in your deck. So let's assume for a moment, right? Let's make the realistic assumption that if there is a LCP correction, if there is a small cap correction, let's make the realistic assumption that we too will fall, right? It's impossible I think it's impractical for any of us to claim that small cap ghus jayega, but we'll be entirely immune. However, if you have something similar to what you saw in Jan, Feb, March, April 2020, some sort of scare, some sort of fear factor kicking in, and and people selling on the back of fear. I think it is but logical that given that LCP has done nothing, right? We see the blue line, which is the LCP ka NAV. It's done nothing for 1.5 years. Given that LCP has done nothing for 1.5 years, it'll be extraordinary if LCP corrects as much as the broader market in a small cap correction. So if you look at the left hand side of the screen, those months of COVID where the red line, the BSE 500 is falling very, really sharply, whereas LCP is falling far less. I think that's the most likely scenario. There is a correction long overdue in small caps. And in such a scenario where a long overdue correction in small caps happens, I think LCP too will correct. But given that it's done nothing for the last 1.5 years, I don't think LCP will correct as much as the broader BSE 500. I should just move forward one slide. I think we've already seen signs of that, right? Ashwin was mentioning that over the last month. Just another slide, right, where you've got the relative movements in BSE. Yeah, so you can already see, right, the BSE small cap is the gray bar in the left-hand side chart. So already in the last 1 month, BSE small cap has fallen more than LCP. And Ashwin, you're saying last 1 week it's been even sharper, is it? Ashwin, you're on mute.
Yeah. So last week the difference would be even starker.
Yeah, so I think this is the
few
most
days
likely sequence, right? BSE small cap has had some insane rally, 130, 140%, without any rhyme or reason to it. So you should expect a correction in BSE small cap. Now, when exactly, whether it's this is the correction or it'll come 6 months hence, I can't time it for you. When it happens, we will also correct. I think should be the logical presumption, but we should correct less than the broader index, much as what we saw in January, February, March, April 2020. Partly because we've done nothing for the last 1.5 years. The correction should be far less. So that's the piece on LCP. So can you time LCP? We certainly can't. If you can time small caps, then you have a God-given skill that we clearly lack. Now the relative question, right, between CCP and LCP, right? I think CCP is more attractively valued. Remember, I gave you the multiple, right? CCP's P is less than 2x the index P, the Nifty P. CCP's P multiple is less than 2x the index P multiple. CCP's ROCEs are clearly more than 2x the index P. So if you were looking at, what do you buy when you buy a company? You're buying the return on capital, right? That's why you're buying the company. You want the share price compounding, but the share price compounding only comes from the return on capital, the return on equity. CCP, you're buying companies twice as productive as the broader benchmark when it comes to return on capital. And courtesy the events of the last couple of years, where people in our country have gone berserk for small caps, you're getting companies like HDFC Bank and Kotak Bank and Asian Paints at very attractive valuations. I think HDFC Bank is 20-year lows on PE. Kotak Bank, I think, decadal lows on PE. But more generally, in CCP's case, you got a situation of very attractive valuations. PEs on CCP are where they were 5 years ago, right? PEs on CCP are where they were when we started the firm in December 2018. Whereas in LCP's case, you can see the PEs are higher than where they were when we started the firm. When we started the firm in 2018, 2019, small caps were in the doghouse then. They've come out of the doghouse, but the kind of the cost of per unit of ROC is lower in CCP than it is in LCP. So if you are to choose between the two, I would say go with LCP at this juncture. So you go with CCP at this juncture. It's cheaper in terms of what you're getting for the price you're paying.
Right. As an extension to that, somebody has referred to your recent blog about how profit concentration is reversing in the country. How should we read that in terms of allocation to large and small cap? Does that work in terms of much more broad-based investing? Is that a reason for us to increase the number of stocks in the portfolio? How does that play out between large cap and small cap as well?
So I think there's actually a lot of data from the government. We've crunched it, but we haven't published it. What the data from the government shows is something very interesting. Beyond what we publish to you is top 20 companies ka profit share in India, and we publish that to you. And you, as you guys have rightly seen, post-COVID, top 20 companies ka profit share has come off. Partly because COVID created such an artificial high in terms of top 20 companies ka profit share. Post-COVID it's come up, but also post-COVID, the government has ramped up infrastructure improvements, which are helping smaller companies get their stuff around. UPI has come to life post-COVID. I think I knew about UPI pre-COVID, but post-COVID, UPI has become a force unto itself. Again, for smaller companies, it's a very powerful boon to be able to buy to costlessly transact uh, costlessly and cashlessly transact for smaller companies. It's been a powerful boon. And I think most importantly, funding availability, access to funding has improved for smaller businesses post-COVID, right? Bank funding in particular has become much more available and at lower cost post-COVID, right? So those are the factors which are helping smaller companies, and credit to the government, credit to the banking system for getting all of this right. If this sustains going forward, that access to capital for smaller businesses is easier, ability to transact through e-commerce, market yourself through e-commerce, pay costlessly through UPI sustains. The road network improvement that we have seen over the last decade continue. I think smaller companies will do well, and you can actually see this again very interestingly in the government's data. The government publishes data on corporate profitability for all tranches of companies. Companies with profits of 1 to 5 crores, how much growth did they show? Profits of 5 to 10 crores, 10 to 50 crores, right? And you can see that 14 to 20, the chotus got hammered. Last 3 years, smaller companies, right? Not just listed, even unlisted. Last 3 years, smaller companies have sort of flowered. They've come into life, and I think if the government continues with the policies that we've seen in the last 3 years of encouraging e-commerce and UPI, encouraging ONDC, I think smaller companies will do well in India in the next 4 or 5 years as well. And those that get listed, we will try to discover them in LCP, and that will be a lot of fun. In a way, we created LCP for that. Ironically, we created it in a very difficult time in 2018, 2019, when it was bloody hard to do. But I think the future bodes well for fund managers like us, fund managers like Ashwin, who are standing there trying to discover companies in the market caps of 2,000, 3,000, 4,000 crores, because a lot of exciting companies will come through if the positive economic policies and the positive economic environment of the last 3 years sustains. But I will add the caveat, folks. The last 3 years of revival in Chota companies' profits came after a long period of real difficulty for Chota companies. Long period where big boys just kept sucking away more and more profit. Last 3 years have been a refreshing change in that regard. For those who wish India well, I think the last 3 years are a very positive portent of the future.
Great. Just moving to the stock specific question, I guess you've covered most of it through your initial presentation and some through the Q&A. A couple of questions I'll take. One is around the recent Supreme Court ruling on hospitals. How is Rainbow positioned? Is that a threat for its earnings growth?
I mean, we don't really see what the government can do here. I mean, Supreme Court has told the government that do something about the fact that CGHS rates and private sector rates are different, but the central government doesn't have authority to fix hospital rates. So health is a state subject, and it's up to the state governments to set rates. And just as just as the Supreme Court can't unilaterally set lawyers' salaries, I don't think the Supreme Court can set lawyers' salaries. The Supreme Court cannot by diktat, neither can the central government by diktat set hospital rates. So I suspect some sort of compromise will be worked out where for all hospitals, whether it is Rainbow or otherwise, a portion will have to be set aside for people who can access healthcare at CGHS rates, and the rest of the hospital will carry on just doing whatever it was before, whether it is Rainbow or other hospitals. And therefore, we're not getting too worked up about the Supreme Court rate. Just if whoever is asking the question, just speak to a lawyer friend of yours, and you'll understand that from a practical perspective, it's impossible for the central government to set hospital rates across the country. It's a state subject, and even if the states try to do it, there are reasons for believing that they will run into hot water on the legal front.
Right. And on GMM, there's a question that if a lot of our companies have, chemical companies, which are supposedly customers of GMM, if they've already expanded capacity and sitting on unutilized capacity, does that mean, GMM's order revival will take that much longer to come? If across the chemical space, there's going to be a runway for growth without further capacity expansion?
So I think where India is well positioned is that the China plus one thing is indeed happening. So those of you who listen to CCP calls where Rakshit explains Divi's lab, you would have heard Rakshit explain Divi's Kakinada plant and how that Kakinada plant is filling up with orders for contrast media. Contrast media is something that China had 90% market share. The Americans got alarmed saying was if China shuts off contrast media supply, we'll be screwed in America. So contrast media, a significant part of the global demand will, I think, gradually come to GMM. And that will be more than enough to fill up the Kakinada plant, right? Our reading is there will be more such China to India migrations of essential drugs, critical APIs. Remember, China has 80% of the world's China has 80% of the world's API production. India has only 10% of the world's API production. So even if India just gets 10% market share gain from China, that doubles our pharma, our API industry. So that process is underway. So in Gujarat, in Telangana, in Vizag, intermediate API plants are coming up. So just to be clear, formulation is the end dawai, API is the critical ingredient, and there are a whole bunch of intermediates which then go into the API. So naturally, the first piece to move is API. Divi's is the fifth largest in the world, largest in India. And then we are also seeing intermediates companies. In fact, Ami Organics is a intermediate company that we've invested in, which supplies to Divi's lab. And we're seeing other such companies come up who are going to be manning the China plus one, China plus effort on API and intermediates. And if you go to these plants, you realize the critical reactor, the critical chemical reactor is always GMM formula. For the lesser critical stuff, chemical plants tend to use non-GMM products, which are cheaper. But for your critical reactions in pharmaceuticals, it's always GMM formula. Secondly, as Ashwin mentioned, GMM has also acquired cleverly companies which do other things beyond the reactor itself. For example, they've acquired a mixing solutions firm called Mixion. So Mixion literally creates think of it as a sort of ladle or a spatula within the reactor, which is moving around the chemicals and mixing the chemicals. So GMM makes the glass-lined reactor, but it has acquired other companies like Mixion, which give you the other bits of the business, other bits of the reactor business. So across the world, as the Western economies revive, leaving aside China plus one, across the world, as the Western economies revive, and specifically as America goes back to make in America, I think we'll see good demand coming through, not just for GMM's reactors, but for the broader solutions piece that GMM is now offering, courtesy the acquisitions, this bolt-on acquisitions they made in the last couple of years.
Just to add to that, I think the pharma piece for GMM is doing fine. I think the problematic is chemical. So pharma is also a big contributor to revenue for GMM. At the global level, services, even though it is not taken up of in India, but services of the existing installed base, etc., that is also a significant portion of the revenue, which is doing fine.
Okay, just one last question. City Union Bank, somebody's noticed that we used to own it in Kings of Capital a few years ago, and we exited. So what's changed now?
So we exited City Union Bank thankfully before the challenges they had with the RBI, and the RBI challenges were around RBI having issues with City Union Bank's systems and processes. What changed is they clearly fixed those, right? So we ascertained that with discussions, not just with CUBK, but also with other banks, that the systems and process issues that the RBI had brought up, specifically around automation of systems and processes, has been addressed. Second thing is City Union Bank went through a period of went through a period of very low growth. We waited for that period of low growth to end. We waited for earnings growth. We waited for clear, tangible earnings growth revival, and signs that loan growth revival was around the corner before we got in. So first was technology upgrade, addressing systems and processes issues. Again, visits to branches, discussions with branch managers to actually ensure that those improvements in technology have actually been made. So loan processing time, for example, from our branch visits over the last 3 months, we believe loan processing time in City Union Bank has been cut down by 70-80% conservatively, right? I think it's been cut down by far more, but just to keep it simple, 70-80% reduction in the turnaround time for CUBK to sanction a loan to a customer. Improvement therein on the back on loan growth, which in turn drives earnings growth. So we needed to see that. We've known the bank for a long time for a variety of our various avatars. We needed to see that these guys could get growth going again. Capital adequacy was never an issue here. This is a well-capitalized bank. Tier 1 ratio is 18%. On the back of what the RBI has done for a variety of banks, right? Uday Kotak Ji at Kotak Bank, Shyam Srinivasan sir at Federal Bank. Here too, RBI said they wanted to see a replacement for Dr. Kamakodi. So we also needed some visibility that that replacement was not going to be, disruptive influence. Again, traveling around Southern India helped get clarity on that. So given that we've seen succession play out in several banks in India now over the last 12 months, we wanted to understand how succession would play out here. And once we got visibility that the succession is unlikely to be disruptive, that growth is on the mend. Technology upgrades have happened. All of that was available to at 1.1 times price to book, compared to, say, when we exited, this was close to 2 times price to book, and it had issues then. We felt that this is a straightforward investment in a well-run Southern Indian bank, which has been through its issues, regulatory issues, tech issues, succession issues, but seems to be coming out of the woods.
Super. Thank you so much, Saurabh and Ashwin. That was a marathon 2 hours plus, for patiently explaining all those stocks and answering those questions. And more importantly, thank you to all our clients who've been listening patiently and have entrusted with us with your money. Hopefully this was useful. There are a few your portfolio specific questions, which, like ever, trust us, we'll get back to you individually in resolving those queries. If by chance we missed out any, please forgive us. Write to us. We'll be more than happy to engage with you one-on-one to answer those. Many thanks, everybody, and have a good day.
Thank you.